all here again. It's staying nice and packed. I like that. Shows your commitment to the material. We'll go over what we did last time, as usual, do a little bit of a recap. So we started talking about practically how we might start using a lot of the concepts that we've talked about vaguely. So obviously we started getting into what it actually looks like to implement things like lateral and vertical integration as we've coined them. Some general guidelines on how you might construct those, while keeping in mind that obviously all of this can be subject to change if you're a more specific kind of investor. So we talked about our stage one, which we like to generally categorize as our liquidating securities, things that we're pulling cash from, things that we're going to spend on other things. Generally, your least aggressive stuff like cash and cash equivalents, your super short-term bonds, things that aren't going to put you at a lot of risk for the most part. And when we move to stage two, we start using some longer-term debts, maybe some index funds, things that are really cheap, stuff that's not subject to a super high degree of volatility, so we still have a little bit of, not necessarily stability, but again, not something that we're looking to see a crash in a very short period of time, but something that could recover within a more intermediate time period. In our stage three, our super long-term goals, stuff that stretches out for possible decades. We talked about how we can hold our more aggressive investments, things that over short term have very strong volatility, very large variation in their returns, both positive and negative. But if we have all of that time and we can stretch out our horizon for those securities, they can end up averaging out to what we might historically be expecting with those. So remembering that each day can be very volatile, it can be very different, but if you put it in the context of decades or however long your measurement of data is, you can get more of an average, more of a reasonable number that can fit into your plan. So we put stuff like growth stocks, our longer term bonds, where generally those have been seen as security, but as we've seen recently can get pretty volatile, so we don't want to make those a haven for our cash and then see interest rates spike up for a year straight and then not have the value to pull out. Junk bond funds, things where we can take on a little bit of default risk, and that's all right because we're willing to get that higher interest over the long period. And some speculative things, new sectors, individual securities, things that you just don't want to, things that aren't as diversified. Basically, as we move further down the stage, we can be a little bit less diversified in some areas, but we still are trying to maintain our base as usual. We dug into our diversification technique, which is what we've coined vertical integration, how we like to structure our positions in each of those stages. So obviously, we like to bias for the most part towards these total market low-cost funds because we want to get general participation for a low fee. Because as we've seen, I'm sure a lot of professionals might have mentioned it to you, these expensive mutual funds don't often outperform the market. It just doesn't really happen a lot of the time. There are short periods of time where they can outperform pretty strongly, but you'll find that over the long term, any strategy that tends to have a very strong performance in a short term often will have pretty equal detrimental effects in other periods that end up averaging it either close to the total stock market or a little below, just because of the fact that their strategy doesn't work in all environments. So that's always something to keep in mind. As we move up, we like to get a little bit more specific, think about sectors that we can rotate between. One of my favorite things to put up in here is cyclical assets, things that tend to have somewhat regular, not quite predictable, but somewhat regular cycles within the economy. So we know that if a certain sector that is part of that cyclical nature is down for right now, we think over time this is probably a discount and we can start to average in. And if we see that a certain sector is really blowing up and maybe we're at a point in the economy where we're going to start shifting, we might take our gains and rotate around. And as we move all the way up to the top, we start to get our managed funds, things where we're getting either super specific or really expensive. Because we don't want to be paying high fees on the majority of our assets, we're willing to pay higher fees on these smaller positions in case there's a particular thing you really believe in and you want to get some exposure to, or there's some fund that just seems to be doing better than everybody else and you want a little piece of the action. So as we talked about, within level one, Really, we're just trying to participate in the overall market trends. We're not looking to do anything crazy. We're not looking to get any extra returns. We're just trying to get some of the market returns for our purposes. Seeking same as the market performance from these assets, whether they're stocks or bonds, so generally things that aren't taking any extra risks, things that are going to give us very run-of-the-mill performance for a very cheap price, stuff that's really inexpensive. And really, what the main thing that these are accomplishing, it sounds like they're doing nothing in terms of the stock market, but a lot of people might end up using something like an S&P index fund for something like this, or a NASDAQ fund. And while that can be good and somewhat diversified, the reason that we like to use broad market or total market is because it really brings down that unsystematic risk that we talk about. So for example, in something like a NASDAQ index, because it's really heavily weighted towards tech, the more you have of that, the more risk you have to the tech sector. And the tech sector could be the thing that drags you down if it has a particularly, we've seen that a few times over. So with our level 1 funds, we're looking for funds that have little unsystematic risk, that diversifiable risk that we can pretty easily scooch to the side. We want to see very little of that within these base allocations. Moving up, we talk about generating exposure to some more targeted things. Like I mentioned, with equities, we can be looking at cyclical assets, different sectors that tend to have some similar up and down movements throughout the economic cycle. Things like consumer staples and discretionary energy, utilities, a lot of these things that they really just do tend to ebb and flow based on what's happening within the economy and how people are doing in terms of their finances in the overall sense. So we're seeking some opportunities in depressed sectors. Really, it's that cyclical nature again. If we're seeing a certain sector that's just been performing absolutely poorly, we might be willing to get a little bit of exposure there in this section just to give us a little bit of an opportunity to capitalize on that return. It's something we do a lot in our portfolios. And we're also willing to throw some more volatile indices in here. So if your total stock market is your base and sort of what you assume is your average for volatility in terms of stocks, we might start throwing some tech indices in here, or maybe some growth indices, just something a little bit more specific with a little bit more volatility that could add to our overall returns. We're looking for higher yield on our bonds because generally this section is not where we want to be pulling cash from. We're willing to take a little bit more risk to generate some extra interest. And a couple different things that you can do with that interest is sometimes we like to, if we have a lot of bonds in a portfolio, maybe some high yields, some corporate, and we aren't really quite aggressive enough to have a large equity, sometimes we like to take the interest off of these bonds and invest that into our growth, invest that into our total stock market indices, just kind of giving us a little bit of almost free exposure, if you will, because it's from the interest of our other holdings. And as we move up all the way to the top, we're trying to take higher risk than we would for our overall risk sort of feeling for the portfolio, our risk tolerance. We're looking to benefit from possibly some tenured management experience. So there's a couple funds that we've already talked about where they have a lot of experience or the management team has been in place and they've really learned how to corner their market and perform in their market. Something like some really well-managed income funds that we've seen, or capital appreciation from T. Rowe Price that you can't buy anymore, but have performed historically incredibly well over the long period. And these allocations remain small for the most part because we're hoping that these are really our opportunity plays. These are the plays where we might have a little less conviction, but there's a lot of upside potential. So we keep these allocations small so that if one of them were to fail, the effect on the portfolio is relatively minimal in the long term. So you got to remember, again, these are not the base, these are not the large majority of your positions. These are small little bits on top that we add to potentially get some extra return. So it's possible that if they succeed, we can add either some additional or non-correlated returns to the portfolio, something a little different than what our majority holdings are doing. Because as you'll see, non-correlated returns are something that can be very important when you start getting really complicated and you start really trying to maximize the benefit of your portfolios. Having stocks, assets, whatever they are, that return in slightly different directions at different times can actually be beneficial for the overall stability of your portfolio and make you not as subject to any one particular event that could bring a certain holding down. And we took a look at this pretty broad stock chart, bond chart. You've got a bunch of different assets starting from small stocks all the way up on the top, large stocks, bonds, treasury bills, and then finally inflation, just to kind of hammer in the point of that this is a long-term gain. And then when we're looking at long-term, we're looking to participate in this whole upward trend. So when you're looking at assets that are like your equities and your growth stocks, you have to remember that yes, as these dips may feel like the end of the world today, in the grand scheme of things, it's just another buying opportunity. And that's kind of how we like to look at it, which is, again, why you just have to make sure that your portfolio aligns with your goals and objectives and is pushing you in the right direction. So today we're going to go a little further into implementation of lateral and vertical integration by building a portfolio. So this is going to be super generic example. It's not going to be perfect for every situation. It may not even be perfect for this situation. It's really an example of the process, and there could be better funds, there could be better allocation sizes, but this is kind of a good place for you to start if you just have no idea really how you want to build your portfolio. And then as you learn the concepts more, or you learn about things that you might want to get into, you can start implementing those with a general guide in your brain about how you want to implement those things and where you'd put them. So just to kind of give a graphic example of what we've been talking about so far, we have our 3 stages. We have our 3 stages of our portfolio, and these can be broken up into more or less, but I think 3 is a good place to start, where you have your cash needs first of all, and you have general sort of some participation or in the market or some longer term bonds, things that are subject to some volatility but don't need a whole lot of time to recover from their standard deviation. And stage 3, where we have a whole lot of time, where things can get figured out and they will grow and then fund our previous stages. And then we have our pyramid with our different levels of diversification, showing that as we go up, positions get smaller. So if we take that, we know that we want each stage to be diversified. We want each part of the portfolio to be diversified. You could stick everything of stage 1 into one single ultra short-term treasury bond, and it's possible that that could be the right move for you. But often we want to diversify these things even further so that if we can get some of that unsystematic risk diversified away and potentially have opportunities in the long run. So you can see here what's represented is each stage being diversified by our pyramid technique, where you can see that in stage 1 we'll have our majority positions in our cheapest fixed income short-term bond fund, and we might move up a little bit. Maybe we add some intermediate term, we move up to the top, maybe we get a managed bond fund, something that hopefully is giving us a little more interest. And you can see the same for each stage as we move forward. So using those, what we're going to do is we're going to build a portfolio from scratch. We'll begin with a 3-fund portfolio, and each fund will correspond to a stage of lateral integration. So we'll start with just one in each stage, and we'll start using vertical integration to build layers on top of that. We're only going to do 3 lateral, 3 vertical, so it'll end up being 9 funds. Generally, we would recommend to do more than that. But again, this is just really supposed to be that super simple example so you can see what the process looks like and how you're going to get to the portfolio you're looking for. So again, we'll be constructing a simple, balanced portfolio, kind of middle of the road, something you've heard of a lot, that standard sort of 60-40 portfolio, which has historically been what everybody recommends for everybody all the time. And we'll be going from the ground up using all the concepts we've talked about so far. So that 60-40 number basically means approximately 60% in equities, stocks, and things like that, and 40% in bonds and cash. So it'll be assumed that this person, that this portfolio is for, we're going to assume that they have some cash needs. So maybe they're taking distributions, or they have something to pay for, or they just like taking a lot of vacations and they need to take distributions for that. Doesn't really matter. But they're also expecting some long-term growth. So it's kind of that middle of the road. I do need to take some cash out now, so I need that to be provided for, but I am also looking for long-term growth, so I don't want to miss out on inflation protection or the possibility to extend the lifetime of the portfolio. So starting first, we have our different stages broken up, and I've got a couple different example funds in here. For our beginning stage, we have ticker FUMBX, which is a short-term treasury bond index. It's really cheap. It's a 0.03% expense ratio, so you're not paying very much. This is almost as cheap as the total market funds we were looking at earlier. And generally, the fund invests about 80% of securities included in the Bloomberg 1 to 5 year treasury bond index. Basically, that just means they're looking at treasury bonds that mature between 1 to 5 years. That's where they're parking their money. You can see that the standard deviation is relatively low. It's under 3%, as well as the effective duration is also under 3 years. And the thing that we want from this is we're looking for not a lot of volatility. Again, yes, the yield is nice, but the main thing that we want to make sure that we're providing for is those cash needs that the investor will have. So these sorts of securities, one, there is, my parent company lets me say this, and the regulators let me say this, they're guaranteed bonds. There's no default risk. Now, if you think that the U.S. government can default, you might have a different opinion on that. But in terms of what we're looking at in the market, these would be considered guaranteed securities where you're going to get your money back. They're not going to default on the loan. It's AAA rated every single time. If they had a higher rating than that, that's what it would be. So we're looking for these super secure government government bond indexes that we can park some cash in for now. As we move forward, we get to our stage 2, which might be some more intermediate term needs. But again, as they're looking for a little bit more growth, this might be where we start with our total market index fund. This one's really inexpensive. It's the one we looked at before from Fidelity, ticker FSKAX. And this fund normally invests at least 80% of assets in common stocks included in the Dow Jones US Total Stock Market Index, which represents the performance of a broad range of US stocks. Now, don't get confused. It doesn't mean that we're investing in the Dow Jones Index, because that'd only be about 30 stocks. But we're looking at one of the indexes that Dow Jones does produce, which is their Total Stock Market Index, which will have, I think I remember it being like 3,800 individual stocks or something along those lines. So this has a standard deviation at the time this was measured of about 18%. So you can expect a decent amount of volatility. But again, since this is not providing for our cash needs, we are hoping that we're willing to sit through that volatility and accept it as it grows to fund the cash portion of our portfolio. Then as we move forward, we can start looking into things that are more volatile. Like I was explaining earlier, this is a NASDAQ ETF. Now, you don't see the word NASDAQ anywhere because Invesco just calls it their QQQ trust. But ticker QQQ is an ETF that follows the NASDAQ 100 index and pretty much is all allocated in that, besides maybe a couple percent for cash. But usually ETFs have almost no cash because they don't need to be redeeming investors. Its expense ratio is a little bit higher, and I believe that these are starting to come down on some of these index ETFs. I know that SPY was a little higher a while ago. The last time I checked, it had dropped down significantly. So it may be a little cheaper now, or it might become cheaper. But there are also other funds that you can find that track the NASDAQ that could be less expensive than this. Again, this is just an example. But you can notice that the standard deviation starts to jump on a fund like this. Because we're more focused on the tech sector, you'll see a lot more volatility, because generally tech funds end up becoming growth funds. That's just kind of how it is. They don't generate a lot of yield, or they don't generate a lot of profit for their shareholders. They don't generally produce a lot of dividends. So these will end up being considered growth stock, and you'll have that higher standard deviation because instead of paying for the dividend, which might be a more stable investment, you're paying for the hopeful growth of the technology in the sector. So again, this is sitting in our stage 3. This is where we want to take the most risk, where we want to see the most growth and be okay with a lot of volatility because we're holding it for the long term. And the long-term chart for NASDAQ looks really nice, but you have to be willing to hold through a lot of volatility, which is, again, why this goes in our stage 3. Theoretically, all needs have been provided for with relatively diversified funds. We could stop right here. A DIY hands-off investor might be satisfied. If you really just don't think you need to be doing too much, if you just want to have a set and forget it allocation and every once in a while check and make sure the levels are okay, you could leave it here. It would be very low work. You'd have 3 funds to pick from. You know exactly what each one does. But having more funds in the portfolio gives us more control over it. It gives us more ability to rotate in and out of areas that could be up or down and look for opportunity. As the portfolio manager, which is what you are if you decide to do this yourself, we desire the ability to take advantage of buying opportunities and rotating between positions. There are a lot of times where we might have a couple different positions. In one of the accounts that I'm managing, I have consumer discretionaries. That's up a lot. But I also have an energy fund that's down a little bit. I could be waiting to rotate into those different positions, but if I only have a couple total market funds, I don't even know that one of those sectors is more particularly contributing to my gains or one is more particularly contributing to my loss. I have to be very willing to just be hands-off and keep contributing and let it move. So if you're somebody who likes to do more, who likes to have more control, and thinks they can make the right decisions, having a larger group of positions will give you that opportunity and can also, if you just hit a massive winner in a certain sector, give you the opportunity to capture that and put it into another long-term position. So with that in mind, we'll move forward and we'll add another layer. So we've got 3 more funds here that we'll talk about individually. Firstly, that comes with Fidelity's limited term bond ETF. Why limited term? Because we're still in stage 1. We're still providing for current cash needs, and we're still trying to not have a great deal of interest rate risk, not have a super high level of standard deviation or volatility, but possibly we're looking to move out of the government sector specifically and possibly open up to high grade other types of debt, like corporate debt. So this one's a little bit more expensive, as you can see, at 25 basis points or 0.25%. But this investment normally invests at least 70% of assets in investment-grade debt securities of all types. Now, something that's interesting about this, the last time that we did this class, this was actually 80% in investment grade. But since then, since I was checking the Morningstar reports on these funds for this class, I noticed that they actually have started to shift their strategy and open themselves up to more high-yield, lower-grade debt. So that's another reminder to check up on some of the things that you're invested in, because strategies can change. Now, while that's not a drastic change in strategy, it is something to know if you're banking on this to be all investment-grade bonds.
What are you seeing in the actual yields?
In the yields, I'm not sure.
Rates of return.
Yeah.
I think this fund is closer to 5.
It's something like that. Yeah.
Rates haven't fallen, so
Yeah.
now we're getting paid for that.
Right. So now that they're shifting into those higher yield, they're starting to try and take advantage of some of those higher interest rates that we've gotten to now, and hopefully ride those as they expect. Possibly interest rates could fall, but again, they could rise, and it could be a slightly more volatility if we have those lower grade debts or some longer duration debts. Now, investment grade, again, we've said this a couple times, but it really just means anything BBB rated or above. And a little bit, once we start getting to how to evaluate funds, we'll talk about what that actually means, but in case you're curious. The standard deviation still is below 3%, so we're still not seeing a whole lot of volatility. We're still seeing a fairly stable investment. And the duration also is still below 3 years, so we're not seeing a huge degree of interest rate risk. If you really, really wanted to eliminate interest rate risk, you might look into treasury bills versus treasury bonds or investment grade bonds because as you know, bonds are longer term and bills are a year or less. So if you really want no interest rate risk, you can go for a treasury bill, but yields will drop along with that. Moving forward into stage 2, remember this is going on top of our total market index. We'll start looking at a Schwab US Dividend Equity ETF, ticker SCHD. These kinds of funds are things that I like because it gives you that exposure to the US stock market without leaning on a whole bunch of tech and really, really volatile securities. While the standard deviation does tend to mirror the total market pretty well, it's still 17% on this fund. The one thing that this fund will be prioritizing is dividend yield. It'll be looking for companies that are paying out dividends because they're profitable. It'll be looking for cash flow. And that's something that just personally I like to have in portfolios, where even if we see not so great returns on a capital appreciation basis, we might still be seeing some interest and dividends coming into the portfolio to make up for a little bit of that, possibly buy in some more cheaper shares if we want to keep increasing our exposure. So this investment seeks to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. You can see that's another one of those indexes that Dow Jones created. And this one's pretty cheap. We would be willing to spend more, but if you don't have to, you might as well not. So this is a pretty inexpensive fund. This is one that we use all the time. Another fund that could be put in an area like this is Vanguard's Value Factor Fund, ticker VFVA. That's the one I've used a whole bunch. And one that I've been looking at recently, which I believe is SPYD, which is a fund that takes the high dividend stocks of the S&P 500 index and creates its own little allocation based on that, while kicking out the growth funds and the super high volatility ones. Moving forward to our stage 3, we've got a mid-cap index fund. So again, still not getting too expensive, still very inexpensive, which is great. This investment seeks to track the performance of the CRSP US Mid-Cap Index that measures the investment return of mid-capitalization stocks. Like we've mentioned before, really we're just looking for smaller companies, maybe companies that have a pretty track record so far, but haven't broke into that large capitalization and still have plenty of market share to go afterwards. You can see that the standard deviation starts to rise a little bit, especially compared to those value funds. We start approaching 20%. We're at about 19%, almost 19.5%. This one is still pretty inexpensive, but again, it's giving us possible opportunity to get a little bit of growth from these smaller companies that just quite haven't hit it big yet. And notice, we're still going with index funds. We're still not going with managed funds. We're not throwing money away at 1% management fees. We're still keeping it cheap because we want to bias towards efficiency, where if we're going to be picking that we're investing in mid caps, we might as well go for an index and pay a low expense ratio.
Question on
Yes.
If one of the stocks hits it big,
Yeah.
and starts growing fast, and they have to sell it, if it gets too
Well,
big capital, and
Yeah, so if it were actually to reach all the way out of mid-cap status and reach into a large cap, yeah, they'd have to sell that stock. Yeah, and then obviously you could have something like a managed fund where maybe they choose to sell it before it reaches a certain level. But yes, with index funds like that, they have to abide to the rules of whatever the index is. So if it grows so much that it jumps off the index, then yeah, they'll change the allocation to match that.
If it stays in, it reallocates a percentage, and so they look at that every quarter.
Yeah, yeah, that too. Sure.
I didn't catch the alternative, the Vanguard's value something.
Oh, Vanguard's Value Factor Fund would be VFVA. Yeah, sure. So now, after that process, we have added another layer of diversification. So what are the benefits of what we just did? Why did we do it in the first place? Firstly, we even further reduced our unsystematic risk. So some of the risks by having certain companies, now that we're adding in even more companies and more different types of assets, we're reducing that unsystematic risk even more. So while yes, we have a total market fund and we have our tech fund, now we're possibly adding a little bit more bias onto some mid-cap securities in our growth area. so that we can diversify that a little bit further. We're starting to go into our fixed income, where remember we had the short-term US Treasury bonds. We're starting to add a little bit of high-grade corporate debt, something that's just a little bit different from our other allocations. And so we have the potential for smaller, more targeted investments to produce additional returns. We're not counting on them to give us the best returns in the world, but we are giving a little bit of opportunity to higher volatility in smaller amounts so that potentially it can add to what our overall participation is. This also gives us the potential for what are called non-correlated returns. And that's something that is really useful in the grand scheme of things when you have returns that simply are they behave slightly differently than other things you may have. The benefit for this is, I've mentioned this example before, but something like if you have a US equity fund that is performing relatively poorly, but you also have a little bit of an international allocation, those might have different performance patterns, and in different times of, say, upheaval in the United States, you might see a little bit of protection, downside protection from those international securities doing better than the US securities themselves. Again, we could stop right here. Some investors may, but generally we like more levels of diversification. The more we go forward, the more we like to diversify further and further and create new opportunities and create new advantages for control. Again, we can stop here. This is a fine portfolio. It'll do just fine. It's just not quite as diversified as we prefer to create them. So we're going to go ahead and add one more layer. So these are going to start to begin. Remember where we are in the pyramid, right? It's reversed here because our biggest positions are at the top. But remember that as we're going down, they're starting to get smaller, more specific, and we're willing to pay more. So these are going to start becoming things that are a little bit more expensive, things that maybe have a good track record or are just doing a job for us. So to start with, we'll look at the PIMCO Income Fund. The expense ratio on this is about 0.5%, which is starting to dig into that higher area. It's not the most expensive fund I've ever seen, but it's definitely not the cheapest either. So this investment seeks to maximize current income, long-term capital appreciation as a secondary objective. Basically, that just means they're looking to generate you as much yield as they possibly can out of the investments. And by doing that, you'll notice that the duration starts to go up a little bit. As our previous two income funds were closer to 2.5 years, now we're crossing over 4 years. This fund has done pretty well in the past, and this is an actively managed fund. It doesn't follow an index. There's not a certain list that we have to stick to. They buy and sell as they please. They create the allocations as they please. And you'll notice that the standard deviation starts to rise a bit. In fact, we are crossing over 5 3/4, almost getting towards that 6% mark. Now, if that's the majority of your allocation, that's going to start feeling a little shaky when it starts going back and forth like that, because that's more volatility than generally we're expecting. That's why we have these large bases in our very cheap, very stable income investments for this stage of the portfolio. As we move forward, we'll look at something from iShares, which is a core moderate allocation ETF. There's a couple different ETFs like this. There's some that are more aggressive and some that are more conservative. And if you are looking for something that really just kind of does a lot of the work for you, these can be great. Keep in mind that while these are asset allocation ETFs, you might think, I need a balanced asset allocation, I'm going to buy the moderate allocation ETF. While that is fine, and that can be a pretty decent thing to do if you have a lot of time and you don't need to be hands-on, if you need to be liquidating assets from a particular portion of that portfolio, if you're allocated in a fund that's doing all the work for you, you don't get to choose where that money comes out of. It all comes evenly out of the whole pie. So you don't get to pull from cash, you only get to sell your share of that investment. So while it does seem like the simplest thing you could possibly do, it also gives you no control on your distributions, your sales, or if something changes, maybe you want to bias more towards a certain area, you don't have that control. but we can use them in certain parts of our portfolio. And if we just want to take up a spot and we don't really want to think about it too much, and we know generally what we want our risk to be, we can always use something like this. This is still a relatively inexpensive fund, so it's really not pushing up into that expensive area, but it is doing a job and it's taking a workload off, which is why I'm putting it up in that third level. So this investment seeks to track the results of the S&P Target Risk Moderate Index, composed of a portfolio of underlying equity and fixed income funds, blah, 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 a lot of words. But you can see the standard deviation starts to hit around 10%, which, if you'll notice later, actually is pretty close to what our overall portfolio is. So you can see that we're trying to get around this area, and this kind of gives us a barometer of where we might expect a moderate or balanced allocation to be. But really, they're just trying to mimic what a common balanced allocation would look like. Not too expensive, so if you want to stick a nice chunk of your portfolio in this to get that allocation for you, totally fine. And lastly, we're looking at Fidelity's Small Cap Growth Fund, ticker FCPGX. You'll notice right away that this expense ratio is the highest of all of them. It's over 1%. In fact, 105 basis points or 1.05%. This is starting to get really expensive, and you better hope that they perform really well, or else you're going to be falling behind the index. So this investment seeks capital appreciation. Their main goal is to grow the money as much as possible. They don't care about dividends, they don't care about interest. They just want to see the assets grow. They want to buy companies that are looking to expand. And they're investing at least 80% of the assets in securities of companies with small market capitalizations. So these are much smaller companies, usually things you've never heard of and probably never will hear of, because a lot of these small companies, there's so many of them that show up and don't really get anywhere. But if you have somebody that can pick some winners, they can be disproportionate gainers in your overall allocation. Now what you'll notice is the standard deviation is around 21.53, which for the category actually isn't quite as high as you might normally see. A lot of small cap funds, especially small cap index funds, can get closer to 30 or 35% standard deviation and really move around a lot. But this is their managed fund. And by no means is this a recommendation. None of these are. None of these are specific security recommendations. Your needs are going to be completely tailored to you. But it's just some examples of what could be placed here. So now we've completed the super bare bones version of what I would do to build a portfolio. Keep in mind, this is a simple sample. This is not at all a finished product. This is not something that's tailored to your needs. This is not something that I would consider to be, the perfect portfolio. If your needs are more complex or your assets are substantial, you should be adding more levels of diversification and possibly even more stages of lateral integration. You might have very specific needs. You might have very small cash needs, but a lot of assets, and you can start changing the sizes of these different allocations. Everything is subject to change. All of this is really just a jumping off point from examples. And if you can look at your own situation and be able to tailor, maybe I don't need so much cash, maybe I do want some more growth, maybe I'm really worried about the growth and I don't want to put that much stress on myself. Using those things to kind of massage these allocations and massage these portfolio ideas to put you in a place that finances your goals and what you want to do, that's what's going to be the best portfolio. It's not going to be the portfolio with the best return, the best diversification, the best any of these stats. It's going to be the thing that best serves your purposes and your feelings as an investor. This allocation is based on a balanced investor. You may be more or less aggressive. Like I was just talking about, you might want a lot more growth. Like for me, when I'm allocating my retirement portfolio, I don't have any cash needs. I don't have a stage one. I'm going completely into growth because even if I touch the money within the next few decades, I would be paying penalties on it anyway. So because I don't have any immediate needs at all, I can really throw the bias towards growth and allow the long term and the time frame to do the work for me. So again, like I mentioned, these securities are not specific recommendations at all, but they're rather generic examples of some possible choices that you might have to put in your portfolio. So we are going to start going over, when we get into another class, we're going to start going over some things you'll see on Morningstar reports, which is our favored method of researching and analyzing and evaluating different securities and funds and portfolios. And you'll see how now that we have all these concepts, how you can start picking funds to put in there. So let's talk a little bit about position sizing. We know that I've been saying that your base positions should be the biggest, and your high cost investments should be the smallest, and all of that stuff. That's great, but like, where should I start? What kind of size should I really be going for? Well, let's remember what the pyramid represents. First of all, we're biasing towards the low cost, broad investments. We're biasing towards things that don't rip away returns with fees, things that are broad, things that don't have a lot of specific risks like unsystematic risk, these diversifiable risks. And the more specific or less diversified and more expensive a position is, the smaller we want it to be in our portfolio. Again, for those two reasons. One, because we don't want to pay exorbitant fees, and two, because we don't want to start to extend ourselves out and expose ourselves to risks that could otherwise be diversified away and have those be a large detriment to our portfolio. So I've got some numbers here, and I want to preface this with, again, super generic, broad numbers. These don't have to be what you have in your portfolio. But if you have absolutely no idea where to begin, or you just want to kind of compare vaguely, this might be a good idea. It might be a good idea to have about 40% of your portfolio in stage one if you are close to this balanced investor. Now, if you don't have really any cash needs, there would be no sense in having almost half your portfolio in stage one. It wouldn't make any sense. It wouldn't make any sense for me to put 40% into a bond index, but it might make more percent for a retiree to put 40% into a bond index and diversify that up vertically. Stage two, you want to have another large chunk of your portfolio. You might split evenly between 1 and 2, especially if you're close to that retiree age, to where you can start getting some of that growth, getting some of those longer term debt securities. And in stage three, you might put about 1/5 of your portfolio so that you have a decent amount of exposure to that long-term growth and those extra things going forward. Now, looking down at the vertical integration, remember how this represents each different stage and how you want to diversify each of those. So when you're looking at your stage one, you might diversify that in a way where just almost half of the position, you could go a little more, you could go a little less, sits in that bottom layer, in that low cost, super efficient, broad market index where you're just participating in that growth. As we move up, we might start to get a little bit more specific, but we're not getting too much smaller because we're trying to still stay not too specific and not too high cost, to a point where we can happily have a decent chunk of portfolio in stuff like value funds, in our different sectors, where we can put those in there and it's not too expensive, but it gives us a little bit more diversification as we start to move up. Then as we get to those final positions, anywhere between 5 to 15% really can be comfortable. Again, it kind of depends on what you're trying to do specifically. But if you wanted to just start somewhere, you could start here and start moving the allocations around until they match what you want better. So if we're doing that with our sample portfolio size of about $100,000, you'll see that each stage gets broken up into these different allocations, where the first stage is about 40 grand, second stage is about 40 grand, third stage is about 20 grand. And you can see that these bottom positions in stage 1 and 2, $18,000, and then 16, and then 6, and then our smallest stage 3, 9,000, 8,000, and 3. Really, again, just visually trying to remind you of that concept of how the positions get smaller, the less diversified and more expensive that they get. So how does that look in our portfolio that we just created? That shows us that we have, remember in our stage 1, we've got our bond index fund at approximately $18,000. We've got our Fidelity limited term bond fund at approximately $16,000. And we have our managed bond fund at $6,000. Now remember, the first 2 allocations are the ones with less than 3 duration and less than 3 standard deviation. So you can see that we're keeping the overall standard deviation and the overall interest risk of our first stage relatively low, and we're adding a little bit of opportunity for some fund managers to give us some additional returns if they happen to have a really good year. And as we start to move forward, we've got our total stock market index as the base of our stage 2. We've got our value fund right above that, or below that in this case, and then we've got our asset allocation for a moderate portfolio in there as well. We've got our broad market value allocation. So that's pretty good. We're moving over to stage 3, and we've got our most volatile QQQ fund in terms of our stages. We've got our NASDAQ index, we've got our growth stocks, and we got more growth stocks, or I think that's mid cap and then growth stocks. So you can see, again, that most expensive position in the whole portfolio is the very smallest. It's only 3% of our overall position. And if I was really building a portfolio, this would definitely get broken up into more things. I'd probably have closer to 5 positions in each of these 3 stages. But again, all kind of comes down to how you want to go about it. So with all of that said, the stats of our portfolio, I have a Morningstar report that we'll look at when we have a couple extra minutes. But when it comes down to it, all of this averages out to an average expense ratio of about 16 basis points. For me, I like to shoot between 15 and 20 basis points, as I feel that generally doesn't reduce returns over the long term as much. Obviously, if you have an advisor, you've got to add your advisory fee to that. But that's, again, one of the reasons why I don't like to pick expensive funds, because if you're going to pay an advisor to do the work, I don't want that portfolio to also be dishing out another 80 basis points to 100 basis points in management fees on the funds when I'm picking the allocations anyway. So that's something to think of. If you're in a portfolio and you get charged a management fee and all the funds are high cost, I would have a bit of a conversation with your advisor, because I just don't want to be tossing that money out the window. And you can see the standard deviation for the last 3 years is about 11%, which, if you recall, is pretty close to that iShares moderate allocation fund that we've got right here. So we start to kind of get close to what that index represents, which is roughly 9%, 10%, 11% standard deviation. You can see that's kind of about how much we're having in volatility. So we land pretty decently on our metrics of what we're looking for, but what could we do to improve this portfolio? Does anybody have any ideas of something that you might do to make this portfolio a little bit better, even if it's just a thought? Sure. Yes?
I believe it depends on the market of the stock.
True. It does depend on what the market's doing. Yes?
As you said, to keep the cost down, but if you have a brokerage account somewhere, you might want to ask the company, what's the combined expenses of the funds, just so you can find out, right? So maybe you're buying funds that are too expensive, or if they're managing it, like Fidelity or some of these other companies, they'll move you towards their funds where they charge you a fee to manage it, but they also get a fee on the funds. Edward Jones or something, is that a company?
Yeah.
We found that they've had high-cost mutual funds in the portfolio, and they don't have to be Edward Jones's funds, but they can get paid part of the management fee to keep them on their platform. And so if you have mutual funds with higher expense ratios that you're being recommended to use, even if they're no load, that brokerage company can get part of that management fee by recommending it. So you want to be very careful about that.
You also run into the same thing in equities. You have reinvestments. If you look at them over the long term, you might be surprised how much money you lose when they're buying stocks for you.
Yeah, and a managed fund, and that's why it's not worth paying a high fee for a managed fund unless they're doing something, maybe an area that's, if it was was a new, they have Bitcoin funds and things like that. If I want to try to do that, I want some young people that know what they're doing, but you are paying for that service, and it's got to be worthwhile. They're doing something you don't want or can't do.
So you say improve, what do you mean by improve?
So by improve, generally what I would mean is kind of following a lot of things that we're talking about, like how could we possibly either add new allocations or add other things that might give us different levels of diversification or different returns, something like that.
The only guaranteed way would be to find funds that have lower costs.
True, true,
Have the international emerging markets.
true.
Depends on the client.
That's super important. I'm glad you said that. But you're exactly right. One of the things that we could, two of the things that I think that we could do is further diversify bond holdings. We have two pretty big bond holdings that are pretty similar. I think there is more that we could do. Not that we're going to add very much of them, but we could add a little bit of high yield or corporate bonds. Yes.
In a portfolio such as that, what type of total return as a client would I expect?
Depending on where the market is, a balanced portfolio, we say that's probably 6 to 8.
Historically, they're at about 8, but let's
Yeah.
just say, if it's 6 to 8 with the S&P is 8 to 10 or 11.
Yeah.
Does anybody know how you can beat the S&P 500? Any idea? You have to buy more of the S&P 500, meaning you leverage it. So if you have 100%, $100,000 in an S&P 500 fund, and the S&P does something, you'll always do the same return minus what? The expense ratio.
Yeah.
So that's why Nash is talking about the lowest cost, so that the expense ratio means nothing. But if you want to beat the S&P, then you buy 130% of the S&P. Say, look, I made this much money, and you're only 100%. Ha ha ha! I beat you. Mutual funds that have an S&P 500 aren't fully invested, are they?
Correct. For the most part, they'll have a small allocation in cash, generally to pay for some expenses or to pay for redeeming investors out of the fund.
I guess you could buy the fund yourself.
You could do a self-directed.
Yeah.
Self-directed.
Yeah, self-directed index or
500.
self-index or
Yeah,
whatever.
and if you had that's a lot of money.
It's
Yeah.
it's a lot of work and
A lot of work, a lot of money, yeah, so you could get
Yeah.
rid of the cost and,
Yeah.
so you make a small bit.
Yeah.
Yeah, the exchange traded fund theoretically is going to do better when the market goes up or greater loss when it goes down, theoretically, because they've got all the money invested. A mutual fund might have 99% invested, so if the market goes up, they're slightly less. If it goes down, if it goes up, they get less. Down, they get less. But that's so small, it's not worth it.
Yeah. Now I want to speak to one thing about you were talking about leverage and how the only way you can beat the S&P is by having more of it. However, something to mention: most of the way that people are getting leverage is either one by buying a leveraged ETF, which is not actually what it sounds like. You might hear a 3 times S&P ETF, and you think, oh, great, I'm just going to get the return of the S&P times 3. Most of the way that those work is they work with special derivative instruments. They don't just buy it, take a loan, and buy more. They'll buy these derivatives that generally reset on a recurring basis, and a lot of them reset every single day. So you'll actually get 3 times of the day's return, not of the year or the decades. And that doesn't sound like really any difference at all, but if you were to actually look at the returns of those funds historically, you'll kind of see what I mean, that it gets to be a negative snowball pretty fast. And secondly, the other way that people get leverage on their investments is using something called margin. I hope you guys aren't margin trading in your retirement accounts, but just in case, one thing to note is that yes, I could theoretically just go out and buy double the shares of the S&P and hold it, but you get charged on the interest. You get charged interest on the money that you're borrowing. So you have to make sure that whatever is going to happen, the return is higher than the interest you would have paid. Now, oftentimes that doesn't exactly work out because the interest can be, depending on the size of your account and a few other things, it could be anywhere from 8 to 10 to 12% a year. So that's not really a gamble I want to take, but something to think about. So again, talking about the things that I think we could do to improve the portfolio, Again, diversifying the bond holdings, something that I'm kind of in the process right now. Now that we're in this kind of market where things are not jumping up and down a lot, there's not a lot of volatility right now in the bond holdings that I'm looking at. I'm starting to just kind of look for things that I can diversify between a little bit of high yield, a little bit of corporate, some longer term government bonds, just kind of get a little spread out without incredibly increasing the risk of my holdings. And the other thing that we could do is add more sector-specific and non-correlated investments. So like she mentioned, those international equities, things that could give us non-correlated returns compared to the US market that we're majority invested in. So if we started adding things like that, we start adding utility funds, consumer discretionary or staples, and sort of getting a little well-rounded in there, we can then have this pool of cyclical assets or other types of sectors that we can rotate between when we have particularly good returns here, particularly bad returns here, and we can have a little bit of movement around there and also be able to see what's contributing to our portfolio. So really just more diversification really is what it comes down to, and choosing things that are different from what we own. So a couple things to remember. Each portfolio will take on a different form based on its purpose. I say this every single class, but it's really important to remember that everybody's portfolio is going to look different. Yours is going to look different than your neighbor's. It's going to look different than your mom's. It's going to look different than your kids because you all have different needs, you all have different risk tolerances, and you all have different ideas of how you want this to go in the first place. A portfolio can be as simple or complex as you like. For example, we have a bunch of larger portfolios that have anywhere from 10 to 15 to 20, lots of individual allocations because we like to have that diversification, we like to have that control, we like to be able to move things around and massage the portfolio as we need to for the different needs, especially if sudden life changes occur and we need to make some adjustments. But for somebody like me, my 401k has 2 whole funds in it because I just don't need that much control. I don't need to do that much more than grow with the stock market. That's really all I'm looking for. So a growth fund and a tech fund is all I want because those are the things that make sense for my current needs. Those are the things that make sense for my goals and what I'm looking for. I want the super high risk because I want the possibility of the higher returns with a whole bunch of time on my side. And that means that I am making sure to stay disciplined to never touch those allocations, and all I do is just keep buying. But regardless of how many funds you have, retain diversification. So even if you have 2 funds like me, make sure that you have funds that are spread out across multiple companies. I don't want to own 2 funds and my 2 funds are one that holds Tesla and one that holds Apple. That's not going to do me that much good if either of those companies just completely fall off a cliff. I still want to have the diversification that we want between different sectors, between different companies, and making sure that we are still not at risk for any of those unsystematic risks that we hammered in before. Bias your holdings towards low-cost investments. Fees can be a major detriment to performance, even with good performing funds. We see this all the time where if you have something like a large cap growth fund and they are pretty good at their job, they match the S&P, but then they charge you 80 basis points. So you lose 80 basis points to the S&P when you could have held an S&P fund that maybe only charged you 5 or even 1.5 I've seen on that total market index fund that we looked at before. So that's one thing to always consider is when you're looking at funds, even if it looks really good and it looks like it's doing the same as the stock market is or maybe a little bit better, make sure you account for the fees and how much that's going to pull you back. Now, the funds that I hold in my 401k are high fee, but that's also because they're managed funds in specific sectors that I have no idea how to work in. I hold a all-cap opportunities fund, which is one that I've mentioned before. I don't want to try and pick small and mid and large cap. If I wanted large cap, I'd buy the S&P, but I want access to everything, and I want, hopefully, there to be high returns based on the historical good performance of these managers, so I'm willing to pay the higher fee for that. Same thing with the tech. It's a fund that I've seen perform really well over the years, something that I'm willing to invest in because I've seen them do well in the sector. So make sure you're biasing towards your low-cost investments. Make sure your portfolio, regardless of how simple or complex it is diversified. I mean, you could still have a portfolio that has 10 positions, but they might all basically just be S&P 500 funds. And again, that doesn't really help you either. So it's important to know what builds up these funds and what you're actually looking at, and making sure that it is fulfilling the purpose that you're looking for. Now, before we get to, we're going to look at a Morningstar report for this portfolio, but before we get to that, do we have any questions on everything that we've just talked about today? Yes?
I have a question. The first segment you showed, the FUMBX,
Yes.
Fidelity Short-Term Treasury Bond Index. Weeks ago, we talked about as far as tax efficiency,
Mhm.
that treasuries were what?
I believe they're state tax free.
Federal?
Yeah, subject to federal only.
They're free
Yeah,
of federal tax?
or free of federal. I think I think treasuries are free of state tax, and you pay federal tax on
Yeah.
those. Yeah, that's what that is.
Okay.
Yeah.
So my question was holding treasuries in a fund versus buying them through Treasury Direct. So the fund you mentioned, FUMBX, is that
Sure.
also free of state tax?
Yeah, so I believe you'll get the same tax benefits there, and the main reason that you would hold a fund like that versus doing it on your own is just so they keep rolling it for you, right? They keep
But you should
getting,
benefit the
yeah,
same
you should
tax
benefit the same tax
Whereas if
benefits.
that was in a money market fund, you would.
Right, right.
There is a tax.
Yes.
What investments would be federal tax deductible?
So if you're looking for federal tax deductions, you'd be looking for municipal bonds, pretty much, is what you're looking for. Yeah, so municipal bonds are federal tax-free, and then if they're from your state, then they're state tax-free too. So if you get muni bonds from your own state, totally tax-free, but the thing that you want to do is you want to see what the municipal bond returns are, see what the treasury bond returns are, and then see what maybe a corporate bond return is, because you'll have fully taxable, partially taxable, and non-taxable, and you want to make sure if you're going for the non-taxable, that it equates to the taxable bonds, because oftentimes, depending on your tax bracket, it could put you in a position where you're just still earning less anyway, even if you don't pay taxes. Yes.
But is it gonna go up for IRMA? I mean, IRMA, I can't use for the IRMA, the extra fees
Oh.
for Medicare, and
Oh, right.
still, it doesn't help me out, does it?
Right. I'm not sure about that actually.
At the back end.
Yeah, I think it probably does. Yeah. I don't know. Any other questions before we start looking at our Morningstar? Yes.
Those things also, you have to make sure that they're not callable, because
Yeah.
they will give them to you and say, here's your long-term cash flow, and next thing you know, it's called, and that cash will disappear.
Yeah, and oftentimes that'll be pretty explicitly mentioned in the name of the bonds, so should be anyways, but something to always check. But most of these, especially stuff like Treasury bond indexes, you're not really going to be worrying about callable bonds for the most part. That's going to be more in your corporate area, but yeah. Yeah, they sure will. Okay, so let me pull up, just so that we can get a little familiar with what we're going to be looking at in the future. We're going to look at the Morningstar report of this fund that we created. That's not the button I'm looking for. Okay, so some of these numbers might be a little difficult to read, but you can see here there's a couple things. We're just going to look at this top area of information first. You'll see a negative cash number, but that's due to some of the fund holdings, and there's not actually a cash allocation in this portfolio. For the most part, if you have a portfolio, especially with an advisor, you usually see about 1% in cash. That's kind of the standard idea, but you'll see that this portfolio does hit just under our 60% of US stocks, with another 2% of non-US, bringing us really close to that 60% allocation. And then you'll see about 45% in bonds, but that's offset by that negative cash number for whatever reason. But we'll start looking at it over here. We'll start looking at the things that we are looking for, which is that diversification. So you'll start seeing the reason why we choose those different funds. because we've got our total stock holdings here, which are almost 9,000 individual stocks. And you can see that they're starting to be pretty well diversified across different areas. Each of these style boxes represents a different style of equity. You've got large caps in this row, mid caps in this row, small caps in this row, value in this column, and growth in this column. Blend is exactly what it sounds like. It's a blend of value and growth. So you'll see that for the most part, we are biased towards large growth, blend, and value. That's where the most of our portfolio is within those larger cap companies, things that are established, companies that have been around for a while and will be around for a while. And you can see that we also have some decent little amount in our mid caps, starting to stretch our diversification into the smaller market, and very small percentages in these small cap equities. Things where we can get those opportunities, but we're not too heavily invested in those areas because we don't want too much extra risk. And as we move over to our fixed income style box, because of what we have right now, we are very strong biased on things like limited term bonds of, for some reason it says medium quality, but most of that is higher quality because of US bonds and things like that. It may just not show up on there. But we'll see the ratings more when we get down to some other sections. So if we scroll down a little bit, one thing that we can also see is we can see that our portfolio does not perform as strongly as what we're comparing to, which I believe is the New York Stock Exchange on this report.
I think that one's the S&P.
Oh, S&P, okay. So we're comparing ourselves to the S&P. It performs very similarly to the total stock market anyway, so it's kind of a very similar comparison. But you'll see that we have a much more horizontal, not quite as drastic return, and that's because of our allocation. That's because of the choices that we made to have more fixed income, to have more cash to pull from. We have to give up some of those upside returns. That also means that this decline here in 2022, between 2021 and 2022, is not as drastic for us. Because we're not as heavily invested in those areas, we also don't feel as heavy of a downturn. So while the market could have been down 30%, we might have been down closer to 15 or 12 or something in that area. We still get a decent amount of growth, but it's not as much as if we had been fully invested. But if we had been fully invested and then this drop happens and we need to start taking money out, we're not happy investors. So one of the other things we can look at is a couple different things are interesting, which are these different parts of the market that we're invested in. So like I was mentioning, those cyclical assets before, things like basic materials, consumer cyclicals, financial services, and real estate. Those are some different things that tend to have different ebbs and flows within the markets. We have our more sensitive assets, which we have a lot of, things like communication services, energy, industrials, and technology, which we have a lot of because of total market funds and NASDAQ funds being pretty biased towards tech. And then we've got our defensive things like consumer defensives, healthcare, and utilities. You can see most of our assets are in North America, as we expect, with just a little bit of international diversification, a little bit in greater Europe, and a little bit in greater Asia. Yes?
How does Morningstar handle the Asia, Chinese? They separate out Japan there, and then it's showing greater Asia. I see Asia developed. Do they wrap China into Asia developed?
I believe so, yeah. They wrap it into Asia developed. Do you think that's about right?
So, and they separate Japan.
Yeah.
Yeah.
Yeah. So we can see if we are comparing to, if we're looking at our best and worst time periods, we can see that our best within the last 3 months of this portfolio, or the best 3-month time period was between April 2020 and June 2020 was about 13 or 14.3%, whereas the worst 3-month period was about negative 12%. Best year was 38, almost 39. Worst year, about negative 13.5. But the worst 3-year period was actually a positive 4%. So we're doing pretty well. And I'll scroll down a bit.
1 year when it says 13.51, if you can see that. The S&P was down 2008
Yeah, so a couple more things that we'll look at. These are some more risk metrics, things that you'll notice on our Morningstar report of your portfolio. So here you can see that our benchmark is over here. Basically what this is our risk reward scatter plot. So it's got two different axes. Down here we've got 10-year standard deviation, which as you remember is basically how far up and down we go from our average returns, how much we're willing to see it go up away from our return and also back down away from our return. And vertically we have our 10-year mean return. So that's our 10-year average. So if we're looking at this, we can see our benchmark has a standard deviation of roughly about 15%, whereas the average return is somewhere around 12. That's about our S&P 500 index funds, so that's about what we'd expect. And we can see our portfolio is this red dot right here. So we could see that our volatility drops pretty substantially all the way from about 15 to about just over 9, maybe close to 9.5. So we can see that over time we're not having as much volatility as was apparent in the graph. When you have the crashes, you don't crash as hard, but when you have the rallies, you don't rally as hard either. So our standard deviation goes down considerably, and our 10-year return also drops a bit to somewhere in the 8%-ish, maybe 9% range. So that puts us pretty much where we were wanting to be based on our allocations. Now, we'll start looking at some of these risk and return statistics. These are things that we'll look at a lot, and we'll look at in more depth later as we learn what they mean. So we've got our standard deviation for the portfolio was about 11.43, whereas the benchmark was 17.66. That's over the last 3 years. So again, we're showing that lower volatility. Versus when you go towards the 10-year, your portfolio is closer to 9.7, benchmark is closer to 15. And you can see on our mean return also, like I mentioned, mean return of the benchmark about 12, closer to 13 here, and the portfolio is around 8.29. Again, right in line with the asset allocations that we're looking for, pretty much exactly what we would expect. Now, if we hop over here to some MPT statistics. Again, we'll describe these in more detail later so you can understand how to use them, but you can kind of think of these this way. Beta is pretty much how risky am I compared to whatever we're looking at. So in this instance, that will be your S&P 500 fund. So you can see that we're approximately 60 to 65% as risky. However much movement we see in the S&P, we're likely to feel about 65% of that, which means again that we see less rallies but also less crashes. And you can see that the R squared, which is pretty much a measurement of how similar are my returns to what we're measuring against, are very, very similar, is around that 97% mark. So our movements in our stock portfolio are fairly mostly due to overall movements in the stock market, which for the types of portfolios that we build is not really that surprising, because again, we're looking for low cost participation in overall market trends. So to see our returns be very similar to the stock market overall is not surprising at all. Now, this other number that we've got here called alpha. Alpha is essentially if I were to look at the returns that we're generating based on how risky we should be in comparison, so if we're taking on about 65% of the risk, how much return are we getting? On a 3-year basis, over these last couple of years, you can see that it's actually not doing too hot for us. We're actually performing a little bit worse when adjusted for the risk that we're taking on. But as we creep closer to 10 years, we start to equalize a little bit. This would be where we might start changing some of our allocations, bring it into Morningstar, swap some things out, maybe lower some fees, maybe kick out that really high fee growth fund that we were looking at from Fidelity, and see if these numbers start to change. Now, remember, all of this is backward looking. All of this is looking at what would have been if you held these exact positions for 10 years straight. So take it with a little bit of a grain of salt, but.
One of the reasons you have a negative alpha for the last three years, and that's more closely to the last year or two, the S&P's done nothing but take off. And so you were paid more, you got more value for taking more risk, and we're left in the dust a little bit. But as you spread it out longer term, then the alpha gets, you don't lose quite as much.
Yeah. So now as we look at a couple more things, the main part that I want to look at here is this section over here on the right. Firstly, I want to look at our credit quality breakdown. As I was mentioning, most of our bonds are in government securities, things that are considered guaranteed, things that would have higher than a AAA rating if they had that rating. You can see that most of our bonds, 65% of them sit within AAA companies, companies that you pretty much have no expectation of default. They're really good on all their debts. They've got a really high credit score. Double A's, we have about 4.5%. Single A's, we have about 11.4%. And triple B's, we have about 15.89%. Now, if you remember that term investment grade, which was basically referring to anything of good quality, is kind of how you might think of it. This is where that cutoff ends. Anything triple B and above would be considered investment grade. And in fact, some people like to consider triple B the sweet spot of bond portfolios because it takes on a little bit of risk without really subjecting you to too much default, and you get a considerable amount of yield from that investment. Now, I like to let bond managers do the work on that, usually for the most part. I like to have my treasury bills, and then I'll let the managers do the rest of the work, maybe get some longer term government. But you can see we have very, very small allocations in any of these low quality bonds just because of how much risk you're taking on for those. While we do have a little bit from our high yield allocations, it's really nothing in the grand scheme of our entire bond breakdown. When we drop down to our interest rate risk, this is where you start looking at how much volatility you'll have when interest rates go up or down. You can see that the average maturity of the bonds is about 5 years. So on average, any single bond that's held in the funds in our portfolio should mature in about 5 years. But because of the rates of yield that we see our duration is closer to 2 3/4, which the way I like to think about it and the way I like to communicate it is you can think of that's approximately how long it'll take for the interest to compensate you and basically pay you back to a point where you could sell the bond, and after all the interest you've gotten back, you'd be at break even. But what a more practical use of that measurement is to think of it as how sensitive is that bond to interest rates. In this example, we'll just round it to 3%. If interest rates were to rise by 1%, we would likely see our bond allocations fall by approximately 3%. So that's kind of how you can use that to measure the volatility of your bonds. Now, the other thing I want to look at, which we already talked about, is your average net expense ratio, 16 basis points. Right within that sweet spot that I like. I like shooting for 15. That's just where I feel like it's really cheap. We're really paying almost nothing, and we're getting all of the performance that we need. But somewhere between 50, maybe 30 if you want to pay a little bit more. That's about where I like to sit. And you can see, again, in our different type weightings, you can see we don't have very much in high yield, not very much in distressed. We have a lot of cyclical assets and a decent amount of these different growth assets. And there's our asset allocations and all those sorts of things. So that should give you somewhat of a decent idea of what our portfolio looks like. Yeah?
I don't know what a basis point is.
So a basis point, pretty much what a basis point is a percent of a percent. So if I say 10 basis points, a tenth of a percent. Yeah. So other than that, that is pretty much everything for us to look at on this Morningstar report, except for maybe we can see.
What is the yield on that?
I don't even think this one said a yield.
Tell you on this page. You can go back to the list of funds when they're laterally lined up, and then it'll give you an average on another page. But the regulators don't want us to be able to say this is what your yield is because there's different variations.
Yeah.
Don't mind telling me.
Yeah.
Yeah, this one does not show us yield
on
at
the
all.
reports I can do the other part that I can find it, I might show it to you, but I don't know if I can print it out. But this particular one's strict. And this particular printout, we have to start putting in what the advisor's fee is also to say if you had this, you would have made 8, but minus 1%, you would have only made 7. That's fine. That's what the
Here
regulators
we
are
go.
starting to do, telling Morningstar, get ready, you're going to have to do this with all these reports. They just don't want people to be misled like you've had insurance agents saying, oh, assumed rate of return 12% a year and all that type of stuff. But the 16 basis points keep an eye on what your funds cost you, and like we say, unless it's really great, T. Rowe Price Capital Appreciation has a .80 or something, but they've outperformed the market, they must be doing something, but most of the funds, we just don't see it's worth it. So watch out for whoever you're with, get some averages and see if they're watching out for you.
So before we go, one last thing that I want to touch on that could help you in diversifying your portfolio further. This is a list of stock intersections. So pretty much what this is doing is it's showing you where your largest individual stock holdings are and what funds they're coming from. So if you really want to dig deep into your portfolio and really start to diversify away from single stocks, this could be something else that helps you. So if you notice all the way at the top of our portfolio, a whole 2%, actually 2.17% of our entire portfolio is directly invested in Microsoft Corporation. If you don't like that much weighting, you might start considering, which of these funds do I want to reduce and replace with something else? We've got our total stock market index. Of course, it's going to hold Microsoft. It's going to hold everything. We've got our Invesco QQQ Trust. Microsoft is a tech stock. Very understandable that it sits in that index. We've got our iShare Core Moderate allocation. Because their allocations inside the fund are often index funds, it's pretty understandable why that might end up being a part of our portfolio. So one of the things that we might want to do is if we want to move away from that and some of these other ones, Apple, Broadcom, NVIDIA, you can see QQQ shows up in every single one of these. So if you were to move QQQ out of your portfolio and replace it with something else, possibly a mid-cap growth fund, small-cap growth fund, really whatever you want that still fits the category, you could significantly reduce the exposure to any of these individual stocks. There's 0.86% of the 2.17% in Invesco, QQQ. So if you ditch the QQQ, this would drop by almost a whole %, and that would bring you to a much lower allocation. Same thing here. You've got 0.75% of 2% of Apple. Same thing down here, almost 0.5% of Broadcom. And same thing down here, 0.65% of NVIDIA. So all of these different things, really just hammering in the different ways that you can diversify and the different reasons why you might want to diversify to get yourself away from the unsystematic risk of holding large holdings in any of these individual companies. But other than that, oh yeah.
So this is a great report as far as being able to see into the portfolio.
Yeah.
My assumption is that you are subscribing to a very expensive version of Morningstar available to advisors only.
That would be
That
correct.
would be, I mean, is there a version of Morningstar that's more, because I don't think I can do this on Fidelity or Schwab's
Yeah.
platform.
Ken, how do we find this?
I use several different companies that offer different information. They all have freebies, and they all hold back certain information. So FINRA has a place that you can do research.
Who does?
FINRA.
FINRA?
They do. The regulatory,
You can do
FINRA, what's
research
FINRA
through
stand
them.
for? Financial,
Also use a thing called
financial industrial,
Yeah, I know. what you mean.
Financial
Okay.
industry,
But I mean,
something.
I know Morningstar has a lot
A
of
little
stuff they
freebie,
want to
yeah.
sell individual investors. I
Yeah.
just wondered if you happen to know if they have a version for individual investors.
we used to recommend
Yeah.
going,
Reasonably priced or
yeah, we
something.
used to recommend, you could call ahead of time, but find a big library, like a Sacramento downtown library, and ask them if they have it.